Good evening, ladies and gentlemen. It's Paul Harrison here after another weekly webinar with our stock market students. Something I want to cover tonight that has really, it's been raised with us two occasions actually on the call tonight. We have one of our rules within our trading one of the criteria we have is to not trade stocks that are less than $10. Okay. The reason we do that is because it's we want to trade larger stocks that a lot of people are trading. We also want to trade stocks that are traded a lot, so there's a high volume on there. The challenge is though is that when people come on board as traders, they always want something to be tangible. Now trading is largely intangible. Obviously you have rules that you have to follow, you have strategies that you have to follow, and the important part there really is that it's so much more the application. Okay, so the actual application of why we do what we do, and really taking the black and white and putting it into the grey environment. Now this the thing what you find with beginners is because they want something to be so tangible, they will go through the actual watch list, and the first thing they will do is they will strip out any stocks that are below $10 or below 200,000. Okay, but those are not the two most important parts. The other three elements we have, the first three criteria, those are the most important parts. I don't mind if somebody's trading between $5 and $10, particularly if they're spread betting. But then, if people are just going through and cutting out anything that's below $10 and below 200,000 on the trading volumes, they are cutting out a lot of stocks. The other side is then something like this. Now, this stock is, as you can see, is trading well below $10. It's trading even below $5 here. And one of our clients Matt raised it with us tonight. He said, what is the problem with trading something below $5? And in my opinion, if it's spread bettable, you're okay to trade it, okay? Because particularly if you're spread betting, because you're not having to tie up the stock. But my concern is that it's firstly it's best practice not to trade anything below $5. But secondly, what you can have sometimes is you can have very, very big players who can move the actual stock quite quickly as well. I'll give you an example here. This stock was pretty volatile around about here. Then pretty passive. There weren't any huge moves. Then it hit a huge move, broke up higher than it had been, and then put in a little bit of consolidation. And then what we've seen is some very, very large moves. Big sell-off there, and obviously I don't know exactly what the reason is for those right now, but what you can find sometimes is if you have a major player in the markets and they can buy and sell and actually move that particular stock. So the bigger the stock, the bigger that the stock is, the more it's traded. Obviously, the less chance we have of that being a problem. But really, it's just about best practice and being able to do that as well. And we as traders, we never know which way the market is going to go. We've got to accept that, and therefore the way we look at it is just trying to get the probabilities in our direction as well. So I hope that gives you some further insight. Maybe it helps you with your trading as well. And I look forward to speaking to you same time next week. Have a great week's trading. Cheers, folks. Bye-bye.